All right, today we're going to pull back the curtain on a super powerful tool for building wealth, one that can sometimes feel like it's a secret just for insiders. I'm talking about dividends. So let's break down exactly what they are and how you can get in on the action.
You know that feeling, right? Like you're on the outside looking in. You hear about people earning passive income, getting checks from their investments without lifting a finger, and you can't help but wonder, did they find some secret money tree that you missed?
Well, the good news is, it's not a secret, and it's definitely not magic. It's a real, accessible strategy called dividend investing, and it's all about making your money finally start working for you, creating an income stream that doesn't require you to trade your precious time for a paycheck.
So let's start with the big question. Why on earth would a successful company just give away its money? It's a great question, and the answer isn't charity. It's actually a really smart strategic move that tells you a lot about the health of their business.
Okay, so a dividend, in simple terms, is just a piece of a company's profits that they pay out directly to you, the shareholder. Seriously, think of it as a literal thank you check for being a part owner of the business. It's a tangible reward for your investment.
It really all comes down to where a company is in its life cycle. You see, a young, scrappy startup needs every single penny it can get to grow, right? They reinvest everything. But a big, mature, established company, well, they often have so much cash coming in, they literally can't find enough ways to reinvest it all. So what do they do with that extra profit? They give it back to the people who own the company. That's you, the shareholder.
All right, so that's the why. Now for the fun part, the how. And I promise, the math behind this is surprisingly simple. You don't need to be a Wall Street whiz for this.
Let's just walk through a quick example. Let's say you invest $5,000 to buy 100 shares of a company. Now, if that company pays a $1 per share dividend every quarter, that means every 3 months you get a check for $100. That adds up to $400 a year sent right to your account.
Now that $400 represents an 8% annual return on your initial $5,000 investment. And here's the absolute best part. You earn that cash without selling a single one of your shares. Your original investment is still there, still in the market, working for you. You know, this analogy just nails it. It really is like owning a rental property. The property itself, your stock, can go up in value over time. But on top of that, you're also collecting those regular rent checks along the way. It's the best of both worlds.
Okay, getting that regular income is fantastic, but what if we could pour some gasoline on that fire? The real, mind-blowing power of dividend investing gets unlocked when you start reinvesting those payments. Let's see how that works.
This is where something called a DRIP comes in. It stands for Dividend Reinvestment Program, and it is the secret weapon for compounding your wealth. It's basically an option to automatically, without you doing anything, use your dividend cash to buy even more shares of that same company. And the best part? It's often totally commission-free. And this creates a beautiful, powerful, self-perpetuating cycle. Your dividend payment comes in, it automatically buys you more shares. Now you own more shares, so the next dividend payment is even bigger. And that bigger payment buys you even more shares. And the cycle just repeats and gets stronger and stronger over time.
Now I really want to drive this point home. This is not a get-rich-quick scheme. It is absolutely a marathon, not a sprint. This is a strategy that rewards patience and consistency over everything else. It's about building real, solid, lasting wealth, not just for you, but maybe even for the next generation.
All right, so you get the mechanics. Now let's level up and get into the strategy. How do you actually find the good ones? How do you separate those solid, reliable dividend-paying companies from the risky ones that could blow up your portfolio?
So you're scrolling through stocks and you see it. A company is offering a massive 12% dividend yield. Your first thought is probably, wow, jackpot, right? I mean, who wouldn't want a 12% return?
Well, hold on a second. More often than not, that is a huge red flag. An absurdly high yield usually isn't a sign of a healthy, generous company. It's often a sign that the stock price has completely cratered because the company is in deep trouble and a dividend cut is probably right around the corner.
So here's what the smart money looks for. First, sustainability. They check the payout ratio. That's just the percentage of profits the company pays out. A healthy range is usually 30 to 60%. They also look for a history of dividend growth, not just a high yield today, but a track record of increasing that payout over time, and of course, reliability.
And if you want the absolute gold standard of reliability, you've got to meet the dividend aristocrats. These are the titans, the S&P 500 companies that have managed to increase their dividend payment every single year for at least 25 years in a row.
And get this, some of these companies have raised their dividends for over 50 straight years. 50. Think about that. Through recessions, market crashes, wars, pandemics, they just kept on raising that dividend. That is the definition of a reliable, long-term investment.
And look, if the whole idea of analyzing and picking individual stocks sounds a bit intimidating, don't sweat it. There's an easy solution: dividend ETFs. Think of it like this. Instead of trying to bet on which pizza place makes the best pie, an ETF lets you buy a small slice of every single pizza in the restaurant. Instant diversification.
So why are we doing all this? What's the point? What's the real end game here? Well, it's about building a future where you are in control, a future where your money works tirelessly for you, instead of the other way around.
This is the dream, right? The ultimate goal for so many people is to build a portfolio that generates enough passive income from dividends to cover all of your living expenses. Just imagine, your investments paying your rent, buying your groceries, handling the bills. That, my friends, is true financial freedom. It all comes back to this one incredibly powerful idea, the dividend snowball. It starts small, maybe just a few dollars. But as you keep reinvesting, that snowball starts rolling downhill, picking up more snow, getting bigger and faster over time, until it becomes this unstoppable avalanche of passive income. So, as we wrap this up, the final question is really about your mindset. Are you focused on today, or are you building for tomorrow? Chasing quick profits is like planting a flower. It looks great for a little while, but it's gone tomorrow. Dividend investing, that's like planting an oak tree. It takes time, patience, and vision, but it grows into something strong and lasting that can provide value for